Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. With this video, I'm going to take a fundamental look at the earnings and price correlated relationship of Celgene, the biotechnology behemoth, with its exceptional and consistent long-term growth of earnings per share. Celgene is clearly a growth stock. It doesn't pay a dividend, but its long-term historical growth rate has been exceptional. At the bottom of the screen here, you can see the change per year for each year's earnings growth rate. Pay special attention right here as to how well the company performed on an offering basis during the Great Recession, connotated by this gray shaded area. But I also want you to notice that as time has gone on and Celgene has become larger, its growth has gone from the mid 30% range, and now more recently it's been moving into the 20% range. And I'll talk about forecasting a little later in the presentation. Next, I'm going to add monthly closing stock prices to the graph so that you can clearly see how the stock price has correlated or tracked earnings. I'm also going to add the normal PE ratio to the graph, which is the dark blue line. Now, when the price is above these orange and blue lines, connotates periods of high valuation, you can see that it had an extremely high PE ratio. And the reason I bring this up is because had you even purchased this, for example, in July of 2006, when the PE ratio was over 120, and held it through today or yesterday's closing price, which now has a PE ratio of only 19, you would have still averaged over 16.5% total annualized rate of return. Of course, there's no dividends. But the point is, as I talked about in the written portion of this article, the power of compounding really came into play. Look how earnings have increased from 27 cents in 06 to 2.98 by 2013. That's more than a tenfold increase in just a few short years. This is really the power of compounding. And so this orange line on the graph is drawn at a PE ratio for this time frame of 37.6. That would represent a PEG ratio because it's the PE equals growth rate of 1. And you can see that Celgene more recently has traded at a lower PE ratio as its earnings growth has slowed down. So now I'm going to switch the graph to a period from 2009 to current, just towards the end of the recession. We still see exceptional growth of 27%. And here, when we add the normal PE ratio to the graph, you'll notice that the valuation has been slightly lower, but these are reference lines. This blue line is a PE of 24, the orange line is a PE of 27. Obviously, in 2012, the PE got exceptionally low, down here to 14 or 15. And had you purchased Celgene when it was really undervalued in July of 2012 and held it to where it's still undervalued, you'd have averaged over 30% a year. This is really the power of compounding. Had you purchased it at a PEG ratio of 1, in this case a PE ratio of about 27, I can get it real close right there, then your long-term return over this point in time would only have been 13% because earnings growth has slowed into the 26% range. So I do want to point out that growth for this company is slowing down, but I also want to point out that the growth rate remains exceptional, and I would consider this stock undervalued at this time. I might also point out that since I started working on this article, Celgene has really been on a tear in the market. My point being that I still consider this stock very attractively valued. However, as I shorten the time frame, I do want you to notice the slowdown in growth. Now we have earnings growth over this time frame of about 23%. And as I'll talk about in a minute, that's about what analysts are forecasting going forward. So if you were to purchase Celgene today and these earnings estimates down here, which I'll talk about in more detail in a moment, would come to pass by the end of 2019, you could possibly see a 30% plus annualized total rate of return purely from growth and appreciation. However, let's move down to the forecasting calculators and look at what analysts are expecting for this company going forward. I want you to notice that there are 25 analysts forecasting $7.28 for fiscal year 2017. That would be a 22.5% growth rate, and 24 analysts forecasting another 21% growth, where earnings go to $8.81 estimate by 12/31/18. So using a 22 PE ratio here, in other words, a PEG ratio of 1, we get that 30% potential number. However, if the PE stayed around the 19 level, which would be this bottom orange line here, the rate of return would still be an exceptional 23%. Now, there's a lot of risk in owning growth stocks because, first of all, you have to have these tremendous earnings estimates manifest, and you have to see valuations remain reasonably attractive. But even if the PE ratio fell to a more market normal 15, you would still have a positive rate of return with this stock. So Celgene is clearly a growth stock. There's no dividends, and it's really recommended for those who are looking for high total return from a very consistent and fast-growing company. However, at this point, I'd like to talk a little bit about how accurate analysts have been. As you can see, since 2010, analysts have been very accurate with their forecasts. For example, in 2009, they estimated $1.15. The company came in at $1.04, so that was a slight miss. But then in 2010, analysts were forecasting $1.03, and the company came in at $1.40. And you can see that most of the estimates in recent years have been very close to being accurate. And that's one thing I think it's important to consider when you're looking at these forecasting calculators, is to understand that the odds are real slim that these forecasts will be perfect. But what you hope is that they're going to be somewhere within a reasonable range of profitability. So before I ever make an investment, I always like to have some idea of what my rate of return potential is. And that's why I developed these forecasting calculators here, because I can very quickly do several what-if calculations. What if earnings did this? What if earnings did that? What would my rate of return potential? So I never buy just with a hope. I'm also always investing with a specific objective, return objective, more or less or plus or minus in mind. Next, I'd like to go into the fund graphs, financial underlying numbers, and take a look at some other important metrics for Celgene. I'm going to start with taking a look at what some might consider the negative with Celgene, which is their debt. I've got total debt per share and long-term debt, which is the dark blue. And as you can see, most of their debt is long-term debt. In fact, looking at their capital structure, approximately 70% of their total debt is long-term debt due after the next 5 years. So the company is very well capitalized relative to the debt, and they generate strong cash flows and earnings to continue to support and amortize that debt, especially considering they pay no dividend. Supporting that statement is a quick look at their liquidity ratios, their current ratio and their quick ratio. As you can see, they have very high ratios of 3 over 3, 4, 5, etc. So the company is very well capitalized in my position, even though they do have some debt. Next, I'll go in and look at gross and net profit margins. The company generates very high gross margins in the 78 to 87, 85, 80% range, and their net margins have been in the 20s, more recently at the 17.8, 17.3% net margins. However, when I look at their most recent quarterly data, their net margins have been increasing over the last 3 quarters, so I consider that a plus. The company's very profitable, obviously, as I illustrated when you looked at the long-term historical graph I started out with. Additional support of profitability is look at their share buyback program. As you can see, they've been reducing their share count while the stock has been undervalued for the last several years. They've gone from about 941 million shares in 2010 back down to 779 million shares. So the share buybacks are also supporting earnings growth as we go forward. I'd like to close this presentation by looking at valuation one more time. As you can see, forecasts for earnings growth are 21 and 22% over the next 2 years, as I discussed earlier. The stock has been very strong over the last 3, 4, 5 days or so, but I still believe the stock is undervalued currently. I would give it a year-end intrinsic value of about $173 a share from $132 now. But longer term, as long as this company keeps growing, I believe it represents an excellent long-term growth stock. And for more detail on the company, I refer you to some of the links that I presented in the written portion of this article. This has been Chuck Carnevale saying thanks for listening.